Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. Very good morning. I'm Kelvin here again. Today will be the Wednesday, the 2nd of October 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so today we have much ground to cover in terms of news flow release and as well as economic data and its impact on the various broad-based cross-asset classes. And I will also highlight one particular very key fundamental and intermarket dynamics that is currently at play right now, especially pertaining surrounding the major US stock indices. Then we will share with you all, as usual, the intraday technical outlook on the various broad-based cross-asset classes, and I will also cover one particular FX cross pair as well on the intraday basis from a technical analysis perspective, and we will actually end today's session with what are the key things to look out for today. All right, so let's start with yesterday's key events and data that took shape yesterday and their impact on the various broad-based cross-asset classes. So what you could see yesterday, we are now yesterday, we do see a rise of geopolitical risk premium due to this further escalation of risk that is taking shape in the Middle East. So yesterday, Iran unfortunately finally retaliated with missile attack on Israel. So I think they fired close to about 2 waves of 100 plus ballistic missiles. So far, minimum damage on Israeli assets, but it gives Israel more reason to actually counter attack against Iran. And we know that Iran itself is a very key player in the internal security environment of the Middle East, and they do have, I mean, they do have, we call it not so rosy relationship with US as well. All right, so because of this retaliation move by Iran, a major player in this, we call it concert or arena of what you call power play in the Middle East, and now with US potentially dragging back into the picture to assist Israel right now, given that it has been attacked by this major player of Iran. Yesterday, we see kind of a mini risk-off event that took shape yesterday. So what I mean by mini risk-off, we see the majority of the major US stock indices fell, or in fact all of them fell over here. So the S&P is down by negative 0.9%. The Nasdaq was the worst because it's a higher beta stock indices comprising a lot of growth AI related play. That means anything that is related to growth. When we see a risk-off event take shape, they will be the first to have a badly hit impact with a higher magnitude. So that actually explain the Nasdaq 100 down by negative 1.4%. The Dow Jones Industrial Average, because it has certain component stocks that are considered defensive in nature, like healthcare, fare much better with negative 0.4%. And another underperformer was the Russell 2000, because the Russell 2000 is also considered as a growth proxy as well, that is much more centered around the localized US economy. And given the fact that this Russell 2000 comprises of US small cap company, their balance sheet health is not as robust as those big caps company listed on the S&P 500. So they themselves also underperformed yesterday by having a negative 1.5%, down negative 1.5%. And what's interesting over here is that so far this kind of globalized risk of impact doesn't impact the Hang Seng indices. So bear in mind, today the Hang Seng market is open. Okay, but the China A share market is still closed. Yeah, it's still closed for holiday, and they will reopen after the National Golden Week holiday on next Tuesday. But what's interesting over here is that the momentum is still very, very positive in the Hang Seng indices, where the Hang Seng right now is actually gaining positive 5%, ignoring yesterday's risk-off event that has taken shape in the Middle East. So right now, the story about Hang Seng is more concentrated on that potential forceful expansionary fiscal policy that right now the top China policymaker would target directly on consumer spending that will be announced pretty soon in the near future. Okay, so there's a lot of this kind of optimism play right now, and do not forget the Hang Seng indices together with the China A shares, they has been underperforming against the rest of the world in the last 3 years. So valuation is considered very, very cheap. And given the fact that globally right now, majority of the central banks are cutting interest rates, and coupled with right now the top China policymakers being more forceful or more generous in engaging fiscal policy that directly target consumer spending and consumer confidence, that lead to what I call this potential positive feedback loop into the China stock market, and as well what we are seeing right now in the Hang Seng indices right now as we are speaking. All right, but on the FX market over here, we do see some form of risk of we call it episode taking place, where the dollar actually strengthened as well. So the dollar strengthened against the euro and the sterling. So if you look at this is a 5 day. So if you look at the 1 day performance that took shape around 24 hours ago. So what we could see over here is that we do see a spike up. You see a spike up over here. The dollar against the euro, the dollar against the the sterling over here. And also what's interesting over here is that the dollar, yes, initially it strengthened against the dollar yen, but then thereafter it actually now try to actually do a bit of pullback over at this point in time. And bear in mind that the yen itself is a bit tricky right now because of this potential ongoing policy normalization that could potentially still take shape in Japan. And do not forget, yen is still part of a proxy risk on, risk off play due to the yen carry trade that has yet to unwind fully after that 5th of August sell off in the dollar yen or the yen crosses. But what's interesting over here is that the dollar continues to remain weak against the China proxy currency, especially the Aussie, what we could see. So despite the fact that the strange thing is that during this kind of globalized risk off event, the Aussie should actually weaken against the dollar. That means this particular turquoise green line here should actually be rallying up somewhere around here, but it's not showing right now. Why? Because the Aussie dollar is now tracking the optimism that is being actually reflected on the related China play asset classes, like a very strong rally that we see right now in the Hang Seng indices. And with that, that actually also managed to have this positive feedback loop impact on the Kiwi dollar as well, where the dollar actually depreciate against the Kiwi. All right, so this is the two outlier or three outlier that we should be watching right now: the Aussie, the Kiwi, and the yen within the FX market. All right, so the rest of them potentially, if you look from a 5 day performance perspective, it starts to rightly go into sideways range ahead of 2 days. This week, another risk event will be the release of non-farm payroll data, and a day before that will be the all-important ISM services data. And for sure, we also see a strong rally in the oil price yesterday as well. So if you look at oil prices yesterday on the daily chart, due to this escalation of this Middle East geopolitical risk premium, oil potentially may be used as a weapon of choice again. So yesterday we see a strong rally in oil, gaining up positive 3%, 3.5%, but so far it's still below that 73.15 US dollar per barrel on the West Texas crude oil. Okay, so later we'll touch more about that when we cover the short-term intraday technical outlook on West Texas oil. And for sure, gold also rally as well. So gold almost added about close to about, I think, 2% plus, something like that. So if you look at the chart of gold, let me open up the chart of gold again for you guys to see. Okay, so what we see over here is that we see a continuation of a strong impulsive up move in the last 3 days. So gold yesterday added 1.4%. Okay, so this is the daily chart of gold. So it seems to us that gold now is benefiting from two sides of this macro event that is taking shape. The first macro event is the continuation of this potential interest rate cut cycle that is still taking shape in the US. Is either will be a very forceful one depending on the current US situation, and later I'll share with you a particular ISM manufacturing PMI data that is not so rosy, that potentially could support much more deeper interest rate cut in the US, which also benefit gold. Why? Because it lowers down the opportunity cost of holding gold, and in terms of heightened or increased geopolitical risk tension that is starting to play out right now after Iran's missile attack on Israel, and potentially there will be further retaliation, given that Israel now has more reasons to actually launch another defensive attack back towards Iran, and that could actually complicate matters with US involvement as well, given that Iran is one of the adversary of US. Okay, so that actually also support gold as well in terms of heightened geopolitical tension. So it seems to me that gold is benefiting from this both sides of this macro event that is taking shape. So later, what are the key levels to watch in the shorter term for gold, XAU/USD? I will cover on the short-term intraday technical outlook segment, okay, in this daily dose. Okay, so now let us focus on other news data that has taken shape earlier yesterday. So one of these data that has taken shape yesterday is on the combined Eurozone inflationary trend that is released yesterday for the month of September. Okay, let me go all the way down on the economic calendar. Okay, where is it? Yeah, here, this is it. Okay, so what you could see on my chart or on your screen over here, this is the core inflation rate year-on-year flash. So it's a preliminary figure for the month of September, excluding food and energy prices. So it actually went down below market expectation by 1 basis point, 2.7% year-on-year, below 2.8 that was being penciled in by forecasts. Market forecast. So if you look at the trend of the core inflation trend in the Eurozone, it continues to show this deceleration path on the downside. Okay, it's hang right now. Let me wait for a while. Okay, give me a bit. All right, so if you look at the 3-year trend, okay, ever since the peak on March 2023 at 5.7%, it continues to plateau and decelerate on the downside, inching towards that 2% target level where ECB desired. So there is lesser risk of inflation reaccelerating back again, but there's a big thing over here is that if geopolitical risk tension starts to go up to a higher level, oil is being weaponized. We see crude oil price being Brent crude and WTI inching back to the $90 per barrel. That could be a big risk. So at this point in time, given that OPEC do not want to actually increase the supply in oil price, instead they will actually increase the oil supply in the cartel. So they're actually in a mode of cutting off supply instead. So that could actually potentially support oil. No, in terms of so-called they are not in a mood of so-called reducing oil supply so fast. Okay, pardon me, they're not in a mood of reducing oil supply so fast, and that could actually see a bit of oil supply that is more on lesser, not so much of a oil supply reduction, then that could actually potentially prevent oil pricing from spiking up towards the $80 to $90 per barrel at this juncture. So we got to see how the geopolitical risk environment unfold in the Middle East. But for now, inflationary trend figure are actually decelerating on the downside in Eurozone. So that actually also saw the euro dollar breaking down below the key short-term pivotal support that we highlighted yesterday as well at the 111.20 level. All right, and back to the data point again. Okay, this is the one I'm showing you, the ISM manufacturing PMI. So in US, ISM manufacturing PMI is considered as one of the leading economic growth indicator that market participants will tend to watch, even though manufacturing is not so much of an important, crucial growth driver in the US, much the one that is focusing more will be the ISM services, which is due on Thursday. But nevertheless, it do have a psychological impact on the market. So the ISM manufacturing PMI, it actually went down below expectations slightly, 47.2. Market is expecting 47.5. All right, so it still continues to show signs of contraction, because anything that's below 50 represents growth contraction in the manufacturing sector. And what's important is that within the manufacturing PMI, they have this manufacturing employment sub index. So this is something like a employment gauge on the job hiring or job firing or the job environment in the manufacturing sector in the US. So this one continues to plummet down quite drastically. Previously, it was at 46. Now it's at 43.9. Market is expecting a slight recovery to 47, but they actually disappoint. So what you could see over here is that the job prospect in the manufacturing sector in US continues to be rather bleak, not rosy at all. Okay, give me a minute. Okay, yeah. So it continues. Where is it now? Yeah, this is the manufacturing employment. So this is it plateau down. Notice there's a big slide down. So you look at the 3-year trend, it continues to print lower, higher, and lower, low. All right. So indicating to us that the job prospect or the job market prospect in the manufacturing sector in the US is not rosy. That means, i.e., it kind of give a bit of pause to the market that's saying that, hey, there's a risk that this recession or hard landing narrative scenario has started to increase by a notch again. All right, in US, that means, i.e., the Fed may be late in the game of cutting interest rate, and they will be forced to cut more, but unable to actually engineer the US into a soft landing scenario, given the state of this ISM manufacturing PMI data. It has a negative feedback loop to the markets, even though fundamentally the manufacturing uh, sector in the US is not still considered as a growth engine, because we know that US is not a manufacturing powerhouse. They are more concentrated on the services sector instead. So the ISM services PMI that is due on Thursday will be much more of a closer watch gauge in terms of the latest economic growth condition in the US. Something to take note of when I covered, I'll touch on more in tomorrow's daily dose as well. And yeah, this is the key so-called data events that has taken shape yesterday and its impact on the market. So before we go over here, that I will share with you the heat map of the S&P 500. So this is the heat map of the S&P 500 taken shape yesterday. So like I mentioned, the higher beta sector got hit, which concentrated on the AI team play, especially Nvidia, which is down negative 3.66%. Drag down Microsoft down negative 2% and Apple 2.91%. So the only one that's fair slightly better will be Google and Meta, both close positive 0.7%. And we start to see the defensive sector outperform, which is utilities and energy for sure, because of a higher oil prices. So if you look at from a sectorial perspective, so they break down according to the 11 groups over here. So we could see, okay, so very clearly the technology sector underperformed, down negative 2.23%, 2.3 partly due to the drag down on Nvidia, Apple, and Microsoft, and the energy and the defensive utility sectors outperform. Communication service thanks to Meta and Google, which is managed to gain by 0.7% each yesterday. So overall, what you could see over here is it's more of a kind of a seek to safety, where defensive and energy stocks managed to outperform against the US, but however, the technology sector continues to bleed, bleeded yesterday. That also dragged down the Nasdaq 100. Okay, so now one fundamental and intermarket dynamics at play right now and share with you is the state of the US stock market, the major stock indices. So let me share with this chart. I think some of y'all may have really seen this chart in my previous daily dose. So okay, let me change this date. So it should be as of today, because this year to date, as of yesterday, pardon me, this is the taking into account of the US session. Okay, one moment, I think it's hang right now. So let me change hopefully I can change the date over here. Okay, I think this thing is hang. Let me shut this down first. Okay, good. Shut this down. Okay, let me go back to the chart again. Okay, gosh. Okay, no mind, let me say it verbally. Okay, so this is 2024 year-to-date performance as of yesterday, which is 1st of October. So take a look at it over here. We know that this is a year-to-date performance chart. So NVIDIA now is positive for 142.95. Okay, yeah, good. I can change the date right now. Okay, this is 1st of October. Okay, ignore all this figure over here because this one is not updated. Of course, this was the previous one. Okay, so I have to save time instead of keying each individually. I just say it verbally. So year-to-date performance as of 1st of October, we know that NVIDIA is that four-star general that is leading the US stock market, both in terms of individual stocks so far among the S&P, among the key stocks, and as well as against the major sector and the major stock indices in US. So most interestingly, every time NVIDIA did a slight fall, there is a spike up in the VIX. So we know that VIX is a fear gauge, a fear gauge. So if the VIX spike up over here, it doesn't gel well for the S&P 500 and as well as the Nasdaq 100, given especially given the Nasdaq 100, especially because the Nasdaq 100 is a higher beta major stock indices. So this was the during prior, even in July, okay, in July 2024, late July, before the 5th of August Armageddon, where the VIX spike up to close to around 36 to 40 level mark. And there was a mini spike up again during late August, okay, late August, 30th of August. Then there we see then it led to a spike up in the VIX on the 5th of September, the first week of September, where we start to see a mini sell off on the Nasdaq 100 and the S&P 500 as well. And right now, the NVIDIA now is also starting to actually do this kind of similar fall, okay, on 26th of September. Then now it starts to go down again. So now you notice that the VIX also now starts to turn up as well. So this could be a very cautious sign, especially on the higher beta major stock indices, US stock indices, the Nasdaq 100. Then it could have a negative feedback loop on the S&P 500 as well, given this latest weakness that is being seen on the major influential AI optimism team play stock, which is NVIDIA. All right, so if NVIDIA continues to slide again in the next few days, it could potentially lead to a spike up in the VIX. So a spike up in the VIX, like what we see similarly on the late August, 28th of August, and on the 25th of July, that could potentially lead to a negative feedback loop on the higher beta major US stock indices, especially on the Nasdaq 100. Then further that, it could also influence the S&P 500. The Dow Jones may not be so bad because it still has some defensive stocks that are within its component stocks, healthcare stocks, but however, the Russell 2000 may get hit as well because it's also considered as a growth-related stocks or growth-related team play in the US stock market. All right, so that will be one of the important ongoing emerging fundamental and intermarket dynamics that is playing out right now pertaining to the US stock market on this chart. So with that, let us now cover the intraday technical outlook, starting with the FX market. All right, so let me expand my screen, okay, so that you guys could see much clearer. Okay, give me 1 second. Okay, starting with the FX market over here. Okay, so starting with the euro dollar. So we know that euro dollar previously the 111.20 was my short-term pivotal support, so it just plunged all the way down. So for today, on a very short-term basis, it's rather mixed element right now. So yesterday it managed to held above the 50-day moving average before bouncing off. So this steep fall over here also lead the RSI, the hourly RSI, into the oversold region, and now it's really exit from the oversold region during the Asia session. So giving a bit of mixed element right now for today, I will turn neutral instead between 110.50, where it managed to find support yesterday, which is also the 50-day moving average, and the upper limit of the neutrality range is 111.12, which was yesterday short-term pivotal support, now turns into a resistance zone. again like an upper resistance zone for this neutrality zone of 111.12 and 110.50, and so very close to the 20-day moving average right now, also acting as an intermediate near-term resistance. So only a potential recovery could be seen if we have an hourly close above 111.12 to revisit 112 figure again, and followed by 112.35 next. All right, so neutral between 111.12 and 110.50 for now on the euro dollar. Now, turning our attention will be the sterling dollar. So the sterling dollar yesterday also broke below a tightened key short-term pivotal support at 133.15 level or so, but however, it managed to find support at the 132.50, the next support level that highlight, which correspond close to the rising 20-day moving average. All right, so given this bounce off from the 132.50, and it also managed to help at the 20-day moving average, we will still maintain the short-term intraday bullish stance or bullish bias on the sterling dollar, but with a lower near-term resistance level to watch for today will be at 133.70. All right, 133.70. So only a hourly close above 133.70 will increase the possibility or the probability of a further recovery to retest 134.35 next on a intraday basis. But however, if price starts to break down again with an hourly close below 132.50, then this minor corrective pullback may extend to the next near-term support zone of 131.50/131 figure level, which correspond to the rising 50-day moving average on the sterling dollar. Okay, so with that, now let us turn our attention to the Aussie dollar. So like I mentioned over here, the Aussie dollar continues to be supported because it's right now a proxy play directed with direct correlation with the optimism in the Hang Seng indices, means i.e. the positive optimism also in the China stock market as well. So the Aussie dollar, despite earlier push down during that so-called spike up in the oil price, or that the Iran attack on Israel, we managed to find support at the 68.70 short-term pivotal support that we highlighted again as well yesterday. So no change since this being supported. We still maintain that intraday bullish bias on the Aussie dollar. 68.70 for sure will be the short-term pivotal support, given that it managed to survive yesterday in that global risk of news flow from Iran, from the Middle East. First resistance level to watch 69.40, above it exposes 69.80 next. All right. However, if a price starts to break down below 68.70, then we potentially see the price of this Aussie dollar shaping that another leg of minor corrective decline sequence towards the next near-term support level at 68.25, followed by 68.25, pardon me, followed by 67.86 next, which correspond to this rising 20-day MA as well. Okay, so that's for the Aussie dollar. Turning our attention will be the pardon me, the dollar yen. So the dollar yen, yesterday we flipped. We have a bearish bias, but price action managed to find support at the 20-day MA, which is at 43.10, before shaping a bounce upward over here. So still no change. These are the two key levels to watch. Still maintain that intraday bearish bias on the dollar yen with 145 figure level as my short-term pivotal resistance, but it got to break down below 143.10. Okay, 143.10 before increasing the odds of another impulsive downward sequence unfolding on the dollar yen to at least test the next near-term support level on 141.40 next. All right, 141.40. But however, if price continues to push up and break above the 145 figure level, then we will start to see another leg of mean reversion rebound taking shape on the dollar yen, revisiting 146.25, followed by 147.20 next. So what's 147.20 is actually the minor swing high area of 2nd of September and 3rd of September. Okay, so that's for the dollar yen. So before we touch on the major major stock indices, one particular FX pair I want to share with you all will be the euro sterling. So the euro sterling was actually featured I think 2 weeks ago, where we have a bearish bias. So price actually hit our support level at 84.20, then thereafter it going to plunge lower. So what I could see over here is that the euro sterling, it has been trading in this medium term ascending trend line channel, medium-term descending trend line, pardon me, medium-term descending channel, my apology, it's been trading in a medium-term descending channel since 8th of August, all right, 8th of August over here. So net overall, is going to trade in this descending trend line. So I'll be using this 83.60 level as my short-term pivotal resistance level for today. Potentially another round of intraday bearish bias could be still potentially playing out in this FX cross pair, the euro sterling, as long as 83.60 short-term pivotal resistance holds. The next support level to watch out for on the near-term basis will be 82.80, followed by 82.60/82.50, a Fibo extension level of 0.618 and 0.764, and as well as the lower limit of that descending channel that is still in play right now. But however, if price starts to break out above 83.60, that will actually negate the intraday bearish bias on the euro sterling to see a push up to revisit the 84 figure level, which is the 20-day moving average, acting as a resistance, and as well as the descending channel resistance as well. A breakout above 84 would actually kickstart a mean reversion rebound towards 84.25, and potentially even this revisit the 50-day moving average, acting as a resistance at the next level at 84.50, 84.55 next. All right, so let me put it in writing. Okay, so net overall, the intraday bearish bias still remains intact as long as 83.60 short-term pivotal resistance holds for today on the euro sterling. Okay, so with that, now let us turn our attention to the major stock indices, starting with the Hong Kong 33, given that the Hang Seng the Hong Kong stock market is open for today. So we see a very strong push up over here. So yesterday we do highlight that this 20,240 short-term pivotal resistance holds the bullish trend should potentially be intact on the Hong Kong 33. So even though it leaves the 20-day moving average by a far gap right now, so this is a daily 20-day moving average, not a 20-hour moving average. In trading view, we are able to plot a higher time frame moving average on a shorter time frame chart like I did over here, but we got still to respect this ongoing bullish trend or bullish impulsive move on the short term on the Hong Kong 33. So given that it already moved a fair bit and cleared above the first resistance level at 21,925 over here, this level has been cleared. So the next resistance level to watch out for will be at 22,600. But with that, we got to tighten the key short-term pivotal support level because this is too low right now. Okay, so what we're going to do right now, let me tighten it. Okay, we tighten it over here. Okay, which is the gap support level. Okay, this level will be 20,880. Okay, let me push it up. 20,880. Okay, then let me remove this. Okay, then given that it may hit the first resistance already, so there could be a chance of a pullback later on. Okay, so this is the pullback zone to watch out for, 21,740, 21,430 pullback zone. So as long as this pullback didn't surpass below this tighten key short-term pivotal support level right now, as long as this minor potential pullback after hitting 22,660, because this 22,660 is important. Why? Because if we go to the daily chart over here, okay, this was the previous rally from short rally from 3rd of November all the way up to 27th of January, 22,660. So this is also the potential neckline of this what we call it double bottom formation as well. So there could be some, given that it's a daily time frame chart, so there could be at least some form of pullback over here at 22,660 potentially, I would say. So as long as this minor pullback didn't surpass below 20 titan key pivotal support right now at 20,880, pardon me, 20,880, we'll still maintain that intraday bullish bias going forward, with the next resistance coming in at 23,550 slash 23,670 next, and the next resistance level to watch out for will be the 2 times Fibo extension level over here above 23,670 will be at 24,750. Okay, let me put it in writing again. Okay, so let me push it down. I'll put it in writing. 24,750. Okay, then I put it in the daily chart. You're able to see confluence with a daily resistance level as well. Okay, so this 24,740, the 2 times Fibo extension. Notice that it corresponds to this swing high area here of 21st, medium term swing high area of 21st of Jan and 17th of February 2022. So that was 2 years ago resistance level. Okay, so now back to the hourly chart again. So, but however, if price action, that minor pullback, right, can't find support at this Titan key short-term pivotal support level of 20,880, then potentially we may start to see that mean reversion decline scenario taking shape on the Hong Kong 33 to expose the next near-term support level at 19,790, followed by 18,980 in the first step. That means coming to revisit the 20-day moving average again. So that's for the intraday technical outlook on the Hong Kong 33. Still maintain that intraday bullish bias with a Titan key short-term pivotal support right now at 20,880, which is the gap support that is being formed in today's Asia session. Now, turning our attention will be the Nikkei 225. So still no change on the Nikkei 225 or the Japan 225. Managed to find support yesterday at the 37,830. 37,830 Titan short-term pivotal support that we have. So still maintain that intraday bullish bias on the Japan 225, but it got to clear above this first resistance zone of 38,620/38,920 that was rejected yesterday. Above 38,920 were much more increased the chances of this recovery to revisit last Friday minor swing high 39,790. However, if price action starts to break down below 37,830, that means for hourly close below it, 37,830, but so far there's no hourly close below 37,830. Yesterday there was a test of it, yes, only before it recover. So if the hourly close below 37,830, then today's intraday bullish bias will be invalidated to see another round of choppy corrective pullback move to revisit 37,410/37,090 next near-term support zone, which is a confluence with the 50-day and the 20-day moving average, and as well as this minor ascending trend line that I drew from the low of 6th of September. So that's for the Japan 225, the Nikkei 225. Turning our attention will be the German 30 or the German DAX. So given that the German DAX has a very close direct correlation right now with China-related proxy stock indices play, especially the Hang Seng Index, given that the China market is closed right now. So if the Hang Seng Index continues to actually shape that bullish momentum, it could have a positive spill over to the German 30 index as well. So yesterday there was a bit of whipsaw around the Titan short-term pivotal support that we have yesterday at this 19,245. So given that the Hang Seng Index is still positive, and the German 30 yesterday sell off due to the Iran attack, managed to actually shape a reversal. So this minor reversal also came very close to this minor ascending channel support that is still in play since the low of 11th of September. So with that, we will still have this bullish bias for today on the German 30, given its direct correlation with the Hang Seng Index, and individually, technically, is still being supported above this minor ascending channel support. So I will use 19,050 as my short-term pivotal support for today. So as long as this 19,050 short-term pivotal support didn't surpass on the downside, we will still maintain that intraday bullish bias on the German 30. So with the first near-term resistance level to watch will be yesterday's minor swing high at 19,460 level. Okay, so above 19,460 potentially may expose the next Fibo extension level, which is the one-time Fibo extension level at 19,550 next. All right, so these are the two key intraday resistance level to watch out for today. But however, if price action instead of going up and starts to push down and have an hourly close below 19,050 level, then the intraday bullish bias scenario will be invalidated on the German DAX or the German 30 to see the extension of this minor corrective decline to revisit the next near-term support zone at 18,820/18,690, which is also confluencing with the rising 20-day moving average as well. So that's for the German 30. So now let us turn our attention to the major US stock indices. So the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 managed to find support exactly again at the 41,950 short-term pivotal support level that we highlighted yesterday. So given that this support level still holds right now, it's still a key support level to watch. So I will still maintain that intraday bullish bias on the US Wall Street 30, but with a near-term resistance level to watch out for will be at 42,410. Only a breakout above this 42,410 will see a much more impulsive up move leg unfolding on the US Wall Street 30 to at least revisit last Friday minor swing high at 42,730. All right, so these are the two intraday resistance level to watch. First resistance, you got the breakout will be at 42,410. Then a breakout above this will potentially revisit last Friday minor swing high at 42,730. But however, if price action break down below this key short-term pivotal support that managed to find support since last Thursday at 41,950, then today's intraday bullish bias will be invalidated to kickstart a minor corrective decline to revisit the 20-day moving average at 41,535. So this 41,535 also correspond very closely to the minor ascending channel support that I drew from the low of 5th of August. Over here, a medium term, all right, because it's more than a month already. Okay, medium term ascending channel support. So that's for the US Wall Street 30. Now, turning our attention will be the Nasdaq 100. So the Nasdaq 100 that I expressed earlier on, because of this negative feedback loop from NVIDIA that is turning weak right now. So given the fact that this potential negative feedback loop that could be inflicted on the Nasdaq 100 due to weakness on NVIDIA share prices. So not so convinced right now of a recovery in Nasdaq 100. So we will actually flip back to a neutrality stance again, given that yesterday it plummeted below the 20,000 level, but managed to find support at the 19,630 level. Formerly, previously was a resistance, now turns into a pullback support, supported on last Friday and yesterday as well. So having a neutrality stance right now between 20,000 and 19,630. So only a breakdown below 19,630 may see the extension of this minor corrective decline sequence at play again to expose the next near-term support level at 19,380, then potentially 19,120 next. So this actually confluence with the 20-day and the 50-day moving average, and as well as this medium-term ascending channel support from the low of 5th of August. Okay, so that sum up the intraday technical outlook on the major stock indices. So right now, turn our attention to the commodities market, starting with gold XAU/USD. So gold XAU/USD almost hit the current all-time high level, which is at this 2,685 before trading sideways again. So still no change. Continues to actually be in a bullish dynamic as it continues to trade within this short-term ascending channel from the low of 9th of September. So using this Tuesday minor swing low, tighten it slightly to 2,625 from 2015. So as long as 2,625 short-term pivotal support holds, we'll still maintain that intraday bullish bias on gold XAU/USD. Next resistance level to watch 2,692, followed by the upper limit of this minor ascending channel, also correspond closely to the 1.382 Fibo extension level at 2,709/2,715 next. But however, if price starts to break down below 2,625, then that would unleash another round of mean reversion decline scenario to revisit the 20-day moving average, now acting as a next near-term support level at 2,590/2,570. The next near-term support zone to watch. All right, so that's for gold XAU/USD. Now, flipping our attention will be the oil market, West Texas crude oil over here. So West Texas crude oil, like I did mention over here, is that yes, it rallied yesterday, but the rally actually stopped at the 73.15 former symmetrical triangle major support level, now turns into a pullback resistance at 73.15. So with that level, yesterday we do have a intraday bearish bias below 71 figure level. Price action indeed plunges slightly below our first support at 68.15 before recovering back again. All right, so with that it kind of element kind of mixed right now, given the fact that there is still OPEC plus to actually consider in terms of their maneuver. But however, oil price could remain supported right now due to the rising geopolitical risk premium up from the Middle East between the escalation between Iran and Israel. So we have a neutrality stance for today. So neutral between 73.15 and 70.10 level, which is the 20-day moving average now acting as a near-term support for West Texas crude oil. So neutral between 73.15 and 70.10. So only a breakdown below 70.10 may revisit 63.15 level, near-term support level, and this so it's a zone. Okay, 67.45. Okay, so let's put it in writing. 4.5. Okay, so neutral between 73.15 and 70.10 right now. Okay, so only a breakdown below 70.10 may revisit the 68.15/67.45 next near-term support zone level to watch out for. So that's sum up the intraday technical outlook on West Texas oil, and as well as the intraday technical outlook on the major cross asset classes that I shared with you. So before we go, for sure, things to watch out for will be how Israel and Iran situation play out for today, and in terms that will be the events, the risk, one of the risk event to take note of out from the Middle East region. And also for today's data, key economic data to look out for will be Japan consumer confidence that is due later at 1 p.m. Singapore time. That could impact the Nikkei 225, Japan 225, and the dollar yen. And also during the European session over here will be rather quiet. We have one European ECB official speaking, ECB Lane speaking at 5:30 p.m. Singapore time. And today's key data to look out for in terms of US will be the ADP employment change. So this is something like a prelude to non-farm payroll data on Friday at 8:15 p.m. Singapore time. Then we have a slew of US federal officials speaking, Fed Hamad and Fed Musalim speaking at 9 p.m. and 10:05 p.m. Singapore time. Then you have the weekly US EIA crude oil stockpile change for the week ending of 27th of September at 10:30 p.m. Singapore time that could potentially impact the short-term movement of West Texas crude oil. And at 11 p.m. Singapore time, another Fed official speaking. So today will be a Fed speaker instead, Fed Bowman speaking at 11 p.m. Singapore time, and early Asia session tomorrow, 12:15 a.m. Singapore time, we have Fed Burking speaking. So that should be, yeah, that is the key economic data and events to look out for today. So with that, this is here Kelvin here signing off. We'll end today's daily dose session, and we shall speak again tomorrow. So do have a great day ahead.